Hello and welcome everybody to today's presentation. In this session, we're going to be covering trading the news, an area often favored by banks and hedge funds as well as individual traders. So without further ado, let's get started. First of all, let's take a look at what we're going to be covering today. We're going to discuss the advantages of trading the news. We're going to look at the highest impact news releases. We're going to take a look at how you can use economic calendars. And then we're going to get into some fundamental strategies for trading the news and also some technical strategies for trading the news. And finally, we'll take a look at some risks that are present due to the volatility when you're trading the news. Starting out with a quote like I usually like to do. Here's one from Jesse Livermore. He says, "The obvious rarely happens, the unexpectedly constantly occurs." So kind of a cautionary note from the trading legend, Jesse Livermore. So in starting out, talking about trading the news, we're going to want to start talking about economic releases and volatility. So trading news largely centers around the publication of economic reports. Countries publish their most important economic data on a defined schedule, often weekly or monthly, sometimes quarterly. And what you see is that the strength of a country's currency is highly sensitive to the state of their economy, as reflected by the economic data in these releases. So as Kathy Lean once said, the economic indicators are really confidence indicators for countries. So when you see strength, economic strength that's bullish for a country's currency, and then there's the inverse, of course. So for traders, the most interesting thing is that economic releases often trigger volatility in the market, bringing regular opportunities. As I said, on a weekly, monthly, or quarterly basis, the opportunities just keep coming. So let's begin by looking at the highest impact economic releases, because these are the releases that trigger the most volatility. This is the data that moves the market the most. So the most important economic releases for any country are interest rate decisions from central banks. If you spend any time in the market, you will have seen, how volatile the market is ahead of central bank decisions and after the decisions are released. Employment data is another huge one. GDP, that's gross domestic product. Retail sales is an important one. Inflation figures, and also industrial production. So usually the most market volatility arises when the figure misses or beats analyst expectations by a substantial margin. So this is where you see the largest opportunities. And being able to gauge what constitutes a substantial deviation from analyst expectations is going to be a key part in being able to trade the news successfully. And so when you have experience watching these releases come out, how the market reacts to the extent to which the figure beats or misses expectations, you're going to have an idea of what might happen in the future. Let's just touch on economic calendars briefly. So you can track economic releases easily online using an economic calendar. There's many economic calendars available, and among the best and most popular are those on Forex Factory and investing.com. And so the data that you get on these calendars, the calendars mark the date and time of the release, the related currency, the level of impact of the release, how important the release is, the figure itself, and of course you also see the analyst expectations and the figure for the prior release. And if there's a revision for the prior release, you'll get that also. So let's get a little deeper in the top economic releases to follow. First of all, as I said, we've got central bank policy statements. So throughout the year, central banks meet to discuss their interest rate policy. So the FOMC, the Federal Open Market Committee, holds 8 regularly scheduled meetings per year. Then we've got Consumer Price Index. The CPI measures changes in the price level of a weighted average market basket of consumer goods and services and is used as a key measure of inflation. So the Fed has a dual mandate, and part of the Fed's mandate is to maintain stable prices with a target inflation rate. So they're looking for a healthy rate of inflation of 2%. What the Fed is actually most afraid of is deflation. It's what you saw in the Great Depression was problems caused by deflation. Then there's employment data. So reports relating to employment are highly important and closely followed by the market. You've got the weekly jobless claims report published every Thursday. And then more importantly, you've got the US employment report, which contains the non-farm payrolls part of it. And that is released on the first Friday of each month. So that's possibly the most anticipated monthly economic release. And then finally here we've got gross domestic product. So GDP represents the total market value of goods and services produced in a country in a given year. So this is the broadest indicator of economic output and growth, and among the most important indicators of the economic well-being of a country. So let's dive a little bit deeper into central bank policy. So nothing has a greater influence on the market than the decisions of the world's leading central banks, such as the US Federal Reserve or the ECB, that's the European Central Bank. So at the Federal Reserve FOMC meetings, they decide the federal funds rate. So that's the rate at which depository institutions lend their balances at the Federal Reserve to each other on an overnight basis. Sometimes it's called the overnight rate. So that rate is decided at these FOMC meetings. That's not the only weapon that the central banks have. Central banks also engage in what's known as quantitative easing, which involves purchasing government securities or other securities from the market in order to increase the money supply. This is what is being referred to when you hear about central banks printing money, literally printing money out of thin air in order to make these purchases. So as an example, in the July FOMC meeting, the Fed actually cut interest rates by a quarter point, which was the first rate cut in 11 years. The market was actually expecting this quarter point rate cut, so the reaction in the dollar was relatively muted. It wasn't a huge reaction in the dollar, but if the Fed had not cut rates, this would have been very bearish for stocks, because stocks want to see lower interest rates. The stock market wants to see lower interest rates. Lower interest rates are good for business, and this would have potentially supported the dollar because currencies typically like to have higher interest rates. So money naturally flows into currencies that have higher interest rates. So if the Fed hadn't cut rates, this would have potentially supported the dollar. So also the language used in the policy statements is something that's very closely followed and can cause huge swings in the market. Let's take a closer look at CPI, the Consumer Price Index, looking at inflation. So the Consumer Price Index measures the price level of a fixed basket of goods and services purchased at a consumer level. So again, CPI is widely viewed as the most important measure of inflation. So how does the market react to this? Higher inflation is typically bearish for stocks, in part because central banks try to control rising inflation by raising interest rates. Again, raising interest rates, something that the stock market doesn't like. Next up, let's talk about gross domestic product. Gross domestic product, or GDP, measures the total market value of all goods and services produced in a country. So GDP basically reflects how fast a country's economy is growing. So for example, US GDP growth has historically averaged about 2.5 to 3% per year. And so how does this impact the market? So a lower than expected GDP reading typically triggers selling in the domestic currency, while a higher than expected reading will support the underlying currency, as you'd expect. So a GDP reading that makes the economy look good will naturally boost that country's currency, and the inverse will depress the currency. Next up, let's talk about employment data. So when you're talking and discussing market-moving economic data, there's a lot of hype around non-farm payrolls. This is a component of the U.S. employment report. The U.S. employment report is released on the first Friday of each month, and it also contains the U.S. unemployment rate for the prior month and a range of other important statistics, such as average hourly earnings. So again, a non-farm payrolls figure that beats expectations will serve to underpin the dollar or boost the dollar, because it's reflecting positively on the U.S. economy, while a figure that misses expectations will likely trigger a sell-off because it reflects poorly on the health of the U.S. economy, or whichever economy you're looking at for that figure. Now let's get into strategies for trading the news. So most typically, you're talking about fundamental strategies, and this is what usually banks and hedge funds and so forth engage in. So there's a few different ways of approaching and trading the news from a fundamental perspective. So by studying the economic data available prior to a news release, traders can form an opinion on the likely outcome and place their orders ahead of time. So for example, the employment component within the PMI report, the Purchasing Managers Index, and also the initial jobless claims report can give clues as to the outcome of the monthly US employment report. So what's going on here is analysts will dig into the existing data and try to forecast what's going to happen on the release of the upcoming data. So actually putting their orders in ahead of the release. So as you can imagine, this is a very complex form of analysis, and this is usually undertaken by large banks rather than retail traders due to the level of analysis that's required. Another common fundamental approach to trading the news is to wait until the release of the report and trade based on how the figure came in relative to analyst expectations. So to give you a simple example, if the UK retail sales figure missed expectations by a wide margin, a trader might take a short position in the pound because that typically is a bearish thing for the pound or for sterling. Yesterday, there was a miss in the US retail sales, which was bearish for the dollar, and the dollar sold off as a consequence. Next up, let's get into technical strategies, and that's usually something that is more appealing to retail or individual traders because it's less complex. So technical traders can also take advantage of the volatility produced by economic releases. How would they do this? For example, a technical trader might look for a major breakout in price in the wake of a release. We know that there's large volatility triggered very often by economic releases, so you can imagine that often important technical levels are breached. So in this scenario, the news might cause price to break through an important technical level, and here, in this case, the trader might enter the market with the expectation that price will continue to trend in the same direction. So it's basically the same underlying thought process as a typical breakout strategy, but it's just being done in the context of a news release. So let's take a look at a chart example of this and how it might have worked out. So going back and looking at the prior data this year, there was an instance that stood out to me in March when the ECB surprised the market with a more dovish than expected monetary policy. So the ECB basically said that rates are going to stay at record lows at least through 2019. And so this statement triggered selling in the euro. We're looking at the Euro-USD hourly chart here. So we can see March 7th here on the hourly chart, and we can see that the sell-off that was triggered by the economic release by the ECB news. Okay, and so if we look here to the left, we can see that there was kind of a shelf of support here. And so a technical trader trading the news may have entered the market after price broke through that support level. And so we could see after the support level was breached, there was a nice fluid move to the downside. So it's kind of a simple example of how a technical trader might have entered the market in the wake of a major economic release with the expectation that price was going to keep trending in the same direction. And in this instance, it did. So it would have worked out nicely. It was the Euro USD had a large range that day of a couple of hundred pips. So that would have been a nice trade. And finally, I'd like to talk about the risks in trading the news. So what you want to know is that typically just ahead of major releases, the liquidity very often dries up, causing the spreads to widen, the bid-offer spreads, and making it harder, more expensive to enter a trade, and also often causing slippage. In other words, not getting into the market at the price that you wanted to, or at a worse price than what you were expecting. You can mitigate this problem to some extent by focusing on the more liquid currency pairs, such as the majors, Euro USD, the pound against the dollar, dollar yen, the dollar against the Swiss franc. Another important thing to be careful of is just leaving orders and stop orders or any other orders in the market, because the wild swings can often unexpectedly trigger them. So it's best to pull your orders from the market ahead of a major release. So with that, I'd like to wrap it up, guys. I want to thank you very much for joining me. Please do contact me with any questions, dan.blystone@Scandinavian Markets, and look forward to seeing you at the next presentation.